Hello everyone, and welcome back to the ECON IQ, where we dive daily into the world of money to help you see the bigger picture and find your rhythm on your journey toward building wealth. In today's episode, I advise you to put down whatever you're holding right now and turn the volume up a little. Why? Because we are standing at a pivotal moment, mid-January 2026. It is very likely that this will be one of the most important turning points in financial markets over the coming decade. And when we look back on these days years from now, you will realize that what is happening now was in fact an early warning signal of a massive redistribution of wealth. You've seen the markets lately, haven't you? They have felt like a turbulent ride that never calms down. Especially silver. Its movement has been like a scene from a horror movie. In one moment, it prints all-time highs, and in the next, it collapses by 7% in a sharp drop, then suddenly snaps back in a strong V-shaped rebound, and then falls again by 2%. Many of my friends who trade futures told me their hearts almost stopped. They got crushed from both sides. And what about gold? Despite the volatility, gold is still gold, holding firm just below the $4,600 level, as if it is preparing to launch. So what is happening behind the scenes? Has the bull market ended, or is this just one last shakeout before takeoff? Today, I want to help you cut through the noise of these confusing charts and see the truth behind this pullback. We are not talking only about prices going up and down, but about a divergence in the market. And based on my analysis of the latest Goldman Sachs reports, the Bank of Japan moves, and the Middle East crisis, the two brothers, gold and silver, are about to take two different paths. Gold is likely to move ahead and accelerate its rise, while silver may head toward a deep and frankly harsh correction amid all this chaos. Why am I this confident? Because three major signals stand behind it, each one as powerful as a nuclear bomb. And today, we will not waste time on unnecessary details or complex technical indicators. Let's look at the big players in this capitalist game and understand how it will reflect on you. All right, let's go straight to the core. First, we must understand the main key behind all this chaos, the indicator I mentioned in today's title, a number shocking even to Wall Street professionals. It is the gold-to-silver ratio, which has dropped below the 50 level. First, let's explain what this ratio really means, especially for those who are new. You might think it's just a simple calculation, gold price divided by silver price, but believe me, it goes far beyond that. It is like a thermometer, an early warning system for the global economy, and its fall below 50 is extremely significant. The last time we saw that was in March 2012. We are facing a rare phenomenon that has not happened in 14 years. So let's return to the history books. Over the past century, the long-term average of this ratio has hovered around 60, which is the equilibrium point. And when it rises to 80 or even 120, as happened during the 2020 pandemic panic, that means everyone is buying only gold to survive, and no one wants silver for industrial use. That is a sign of intense fear and a struggling economy. But when the ratio drops below 50 or even tests 40 or 30, history tells us there are two possible outcomes, and both are extremely dramatic. Scenario 1 is gold is far too cheap. The market suddenly realizes that gold, as the ultimate monetary asset, has not yet been priced as it should be, so gold launches into a revenge rally to bring the ratio back to normal. Scenario 2 is silver is in a massive bubble. Speculators have pushed its price to unrealistic levels, which leads to the bubble bursting and a sharp drop to restore balance. So, in January 2026, which scenario are we living? My view may be difficult for some. We are facing a historic split, where gold accelerates upward while silver enters a correction. In other words, these twin brothers in the metals market are about to separate. And this is not a random opinion. It is built on deep analysis of three main signals: Wall Street's hidden plans, a currency war in Asia, and the drums of war in the Middle East. Let's start with the first signal coming from the heart of the global financial system: Goldman Sachs. For a very long time, Goldman was the biggest promoter of the idea of a strong dollar. They convinced everyone of what is called American exceptionalism, and the core of their thesis was that Europe is suffering and emerging markets are in chaos, while the United States is unbeatable thanks to AI and technology stocks. And based on that, global capital had no choice but to buy American assets. This logic kept the dollar strong for years. But in their 2026 outlook, I noticed a rare shift in tone, one closer to concern. Goldman has effectively begun raising the white flag. They openly admitted that the dollar's dominance has started to fade. Pay close attention to their wording. They speak about a slow decline, and they warned that even though the dollar won't collapse tomorrow, faith in the idea of American exceptionalism has begun to crack. What is the biggest danger here? It is a structural shift. Goldman pointed to an extremely worrying possibility. What if confidence in U.S. technology stocks collapses? The U.S. market today is heavily concentrated in a limited number of AI giants. It's an extremely crowded trade, and if a technical failure occurs, or if these giant companies cannot justify their inflated valuations and big capital starts exiting, then the dollar could crash with a force beyond all expectations. And have you noticed something strange recently? Goldman pointed to a decoupling between U.S. equities and the dollar. Usually, when stocks rise, the dollar rises because foreign investors need dollars to buy those stocks. But now, stocks are printing new highs while the dollar index is falling. That means smart money is hedging. It buys stocks like Nvidia or Microsoft, while at the same time betting on a falling dollar. And this is an extremely dangerous signal. It means capital still bets on U.S. companies, but it no longer bets on the financial credibility of the United States as a country. Investors are now saying, "We want your AI technologies, but we do not want to hold your paper currency." This shift in the stance of major banks is often the ignition signal for a major trend reversal in markets. If de-dollarization was just a slogan over the past decade, it is now a real trading strategy on Wall Street in 2026. And when the dollar's throne shakes, where does trust go? There is only one answer: gold. And that is why gold is preparing to press the accelerator. Now we move to Asia, specifically to our neighbor Japan, and this is the second pivotal signal. Recent moves in the Japanese yen have left many FX traders confused. It collapses in 1 minute, then jumps strongly in the next. And behind the scenes, a high-stakes game is unfolding between market speculators and Japanese officials. Nomura, the largest brokerage firm in Japan, has just issued a red alert. The signals indicating Japan is preparing to intervene and rescue its currency are flashing bright red. Their finger is already on the trigger. And here I want to teach you an important professional term: rate check. It is not actually about reviewing prices, but an intimidation tactic used by the central bank. How does it work? When the exchange rate becomes extremely volatile, a Bank of Japan official suddenly calls the major banks and asks, "Where is USD JPY trading now? Do you have large sell orders?" The call itself is not a trade, but the implied message is perfectly clear. We are watching you. Do not push further, or we will intervene directly in the market. Nomura also noted that during London trading on Wednesday, the USD-JPY pair saw a sharp and sudden drop with no clear reason. Nomura analysts believe this was most likely a covert rate check or a limited scope test of the waters. And what does that tell us? It means the Bank of Japan is trapped in a tight corner. A weak yen causes massive inflation inside Japan. When people go to the grocery store, prices rise day after day, and companies face suffocating pressure because of import costs. This could force the BOJ to raise interest rates at a much faster pace than expected. The market expected the bank would wait until summer, but to save the yen, it may have to pull the trigger early. This is hugely important. Japan is one of the world's largest lenders, and if it shifts to a hawkish monetary stance, tightens money supply, or even sells U.S. treasuries to buy its local currency, that is like pulling all the excess liquidity out of the global financial system. So what happens next? Global asset prices begin to swing violently, what we call the carry trade unwind, and gold thrives precisely in this kind of chaos. Historically, every time the yen reverses sharply, investors rush toward gold as a safe haven. So a butterfly's wing beat in Tokyo could ignite a gold storm in New York and London. As for the third signal, we have to look at the powder keg in the Middle East. If you follow the news, you might think tensions with Iran have eased slightly recently. But let me tell you, this is only the calm before the storm. This is a phase in which a much deeper conflict is fomenting. Why? Do not look at what politicians say, watch what the military does. Forces do not lie. Recent intelligence information indicates that as tensions with Iran rise, the United States is redeploying massive forces in the Middle East, most notably the aircraft carrier Gerald Ford, the most powerful nuclear aircraft carrier in the world. It was supposed to be elsewhere, but reports indicate the White House is moving it to the Middle East along with additional reinforcements for missile defenses. This gives President Trump a real military option, and the message is very clear. The United States does not believe Iran or Israel will back down. This current peace is only a reshuffling of cards before the next move. On top of that, there's an important concept here called the war economy. Some experts have noted that the Trump administration is effectively running a form of hidden quantitative easing, shadow QE, printing money indirectly. What does that mean? Think about it. Defense budgets, supporting allies, and rerouting supply chains all cost enormous fortunes. Where does all that money come from? From issuing more debt and inflating the balance sheet. And this is long-term fuel for gold. War is not only about fighting, it's about burning liquidity. And when the world moves into war mode or security first, the value of paper currencies inevitably erodes, and gold becomes the best shield against that. If the crisis with Iran escalates, or if the carrier's entry into the Arabian Gulf is confirmed, gold's status as a safe haven will explode, breaking above $4,600 into a new upward wave. Now, after we covered the big picture for gold, let's move to the metal everyone has a love-hate relationship with right now: silver. What has happened with silver lately has been like a real meat grinder. It fell 7% yesterday, destroying leveraged accounts, and today's rebound is still weak and stumbling. Three forces are playing a high-stakes game here: physical supply, Trump's policies, and a hidden change in trading rules. Let's start with the first force, the physical gap. And this is the reason silver bulls are so confident. I said it before, the logic of silver is strong. We have been running a silver deficit for 5 consecutive years. This is not media noise, it's a real shortage of physical metal. Data indicates that the risk of a supply squeeze in the futures markets has reached the highest levels ever. Look at this insane number. For every 1 ounce of silver sitting in warehouses, there are huge paper claims. Around 590 million ounces of paper silver have been bought. But how much physical silver is actually ready for delivery in the warehouses? Less than 50 million ounces only. Do the math yourself. 50 million versus 590 million, a coverage ratio that doesn't exceed 7%. That means if 100 people wanted to take delivery of their silver physically, the warehouse only has enough for 7 people. The other 93 will get cash compensation or a delivery failure. And that's why silver surged. Everyone was fighting for the last few seats in the room. It's literally a game of musical chairs. And with China adding restrictions on silver exports that began on January 1st, the shortage gets even worse. This is the bullish scenario for silver. But the second force, Trump's latest move, hit the market like a ton of bricks. At the exact moment silver reached its peak, Trump tweeted that he would delay new imposed tariffs on imported strategic metals. The market expected tariffs would disrupt supply chains and push silver prices higher. But Trump said, "Let's talk first. No increases now." Suddenly, fear of an immediate supply shock evaporated. Many traders sitting on huge profits decided to sell immediately, and that's what caused yesterday's 7% collapse. That's how market mood can flip quickly on news. But the third force is what actually moved the indicator, the CME ruling. This technical detail slipped past most retail traders, but it's likely the reason you lost. You lost against the rules. On January 13th, the CME Group quietly changed risk management rules in a way that's deadly for leveraged traders. They changed how required margin is calculated, from a fixed dollar amount to a percentage of the contract's value. Under the old rules, whether silver was $30 or $50, the required margin for the contract was fixed. That meant every time price rose, your position value increased while the required margin stayed the same. In other words, leverage automatically grew, and speculators loved that. The higher price went, the more they could buy. But CME said, enough. Now margin is calculated as a percentage of the total contract value. If silver rockets and the contract value reaches $500,000, you'll suddenly be forced to provide $45,000 as collateral. And what does that mean? It means the higher price goes, the more cash you must freeze. This is a real nightmare for high-leveraged traders. You thought you could use your profits to increase your positions, but the exchange is telling you your profits are not enough even to cover the new margin. That forced a huge number of long positions to close. They could not handle the margin requirements, so they were forced to sell. And that selling pressure is what stops the current rally. So CME effectively intervened to cool the market and blow up the speculative bubble. And when you combine these three factors, the picture becomes clear. A long-term supply shortage, bullish, versus Trump delaying tariffs, bearish, versus CME rule changes, deadly to leverage. The result? Silver's rally hit a wall. That is why my core message is, the ratio broke below 50 and the split has begun, and here is what the future looks like. Gold is supported by a weakening dollar, the yen crisis, and Middle East tensions. It also does not carry the same speculative load that silver does. On top of that, central banks are buying it aggressively, so gold will lead the next phase. Its movement will be more stable and stronger, and it is likely to keep printing new highs. As for silver, I am still bullish over the long term, but in the short term, because of leverage liquidation and fears about industrial demand, silver will be violent, volatile, and chaotic. We may even see a deep pullback. The market must shake out weak hands, and the gold-to-silver ratio must return toward the 60 level before the next launch. So here's my honest advice to you. First, regarding silver, it is time to calm down the greed a little. The outlook is good, but right now we are watching a clash of gods. The new CME rule is a sword of Damocles hanging over your head. Do not use high leverage here. This volatility can wipe your account to zero in a single day. If you own physical silver, just hold it. Owners of the real metal will win in the end. But if you trade futures or paper silver, now is the right time to reduce your positions and manage risk before panic gets worse. Second, regarding gold, you can have more confidence. In the uncertain world of 2026, with a weaker dollar and the shadow of wars approaching, gold remains the strongest shield you can own. And if the correction in the gold-to-silver ratio continues, gold's rise may surprise you more than you expect. And one final idea I want to leave you with. In financial storms, survival matters more than quick riches. My goal is to help you see risks, not gamble. This is not official investment advice, but sincere words from someone who has spent a long time in these markets. Trading is your responsibility. Make your own decisions and protect your money. That's everything for today. If this analysis helped you understand this crazy market, please leave a comment. And don't forget to like the video, subscribe to Econ IQ, and share it with your friends. Stay safe in the storm, and I'll see you next time. Goodbye.